Dipanshu, you can go ahead. Yes.
Okay, thank you, Mehul, for having this session. So, I'm Devanshu. I did my bachelor's and master's from ISI Kolkata, and currently I work in one of the leading US investment bank for 4 to 5 years in different domains. Like I worked under credit risk domain as well as I worked under macroeconomic forecast and variables forecasting, the econometric modeling domain. So I think based on my experience, I prepared this training. So this training is or can be used only as a primer for the basic fundamentals that one should know to understand the IRB credit risk modeling. But needless to say, definitely the knowledge of IRB modeling doesn't end here. It's just a start. Also, one or two more pointers. I think last session was taken by someone else. So the previous speaker has mentioned elaboratively a lot of topics on how to model PD, LGD, or EAD under different formats. I just tried not to be boring by repeating over the same things again and again. So I came up with something which is completely different from from last week's session. So yeah, I'll mention the exact specifics and the exact areas where I think where some of those areas can be applicable. But without further ado, we can start. Okay, so today we'll be covering these few topics. So majorly a life cycle of credit risk IRB space models. What is the IRB modeling? What is basic Basel guidelines? And what is the aftermath? So as you can see, Basel, it starts with Basel guidelines. Then I discuss about the basic capital calculation formula, which is a key component of this kind of modeling, the basic framework, data preparation, methodology, uh, pre and post monitoring kind of pre-implementation and post-implementation monitoring kind of things, and the proper remediation around it, key challenges for this kind of modeling, and what what are the new emerging techniques that is in the market. So after every slide, or not for every slide, maybe 1 to 2 slides, I'll give a little bit break for you to interact with me, ask me some questions or doubts. I would be happy to answer those. So we can start. So basically, Basel guidelines. So Basel has four version of guidelines. So this has been done by supervisory committee only. So which is named as BCBS. So basically, they came up with an approach for financial institutions to follow, that how much capital should a bank keep as a reserve in a 1 year window for the financial institution or bank to withstand any kind of financial risks. So as you can see that, I mean, the Basel one was done somewhere in late 1980s. So back in that time, I think 35 years has passed. From there, as you can see that this is a risk is not a static framework. It is a continuous ongoing framework which makes incremental changes and which gets improved years after years. How some come from the research, some come from the financial crisis kind of event, and coming from some coming from the business needs. So, today the way we see as Basel, it was quite different when it was first introduced. It used to just calculate. I mean, it came from a basic simple idea that I am giving you a loan. So there is a chance of you, when I am giving you a loan, there is a chance that you not repaying me back. So how much should I keep, I mean, if I give you $100, so how much should I keep as a reserve? Except, I mean, with respect to that. Because if I give it to multiple lakhs of customers, everyone will not default, as well as there would be someone who would default. So, what is the correct amount of uh, money that the bank should keep at a reserve so that it will help the bank when the actual write-off happens for loss provision? So from that particular concept, I think the whole regulatory capital idea came up. Now things gets changed when in 2004 Basel II came. So for Basel II, so as you can see, the what I explained right now is just Basel One. So Basel One had no idea. I mean, it is just like few people giving some other people some loan and some capital assessment around that. But as you can see, that financial institution is lot more beyond that. So they identified three key areas. Those are credit, market, and operational risk. So for any kind of assets which goes falls under these categories, they need to put a capital according to it. There is a minimum capital requirement which has been decided. That is the pillar one. That is the pillar one of the Basel II guideline. The second thing which came in the Basel II guideline, that the banks need to build their own risk assessment framework to to calculate and keep some amount of risk-weighted asset, I mean, some percentage of value of their risk-weighted asset as a separate capital, and a review process for those kind of risk assessment and capital adequacy framework will happen. The third thing is whenever bank do some business via some kind of strategies, they cannot do that. Okay, it is our secret. We are not going to disclose it in front of regulators. They actually need to disclose what risk they are exposed to, what is their capital planning, what is their capital structure, what is their risk assessment method. So based on these three pillars, Basel II was introduced, from which hope the difference is now basically since the bank needs to build their own risk management practices within the firm itself. So basically, Basel II was about redefining risk management standards and also improving risk sensitivity. Now, as you can see that I have highlighted this pillar one specifically because this is the exact area where IRB modeling came from, which is the topic for today's session. So for this kind of calculation, for this capital calculate requirement calculation, actually the Basel, I think IRB based modeling came from. So 2004 Basel II was fine, well and good, but then global financial crisis happens. So after that, what they what Basel committee understood and focused on, that if you closely follow or if you know a little bit more, dig deeper into the financial crisis, then you will see that the risk management procedure was there, but we cannot do anything if bank decides to keep lesser capital, because as a financial institution, if financial institution needs to keep aside some amount of capital, that is the capital they cannot use as a part of their general operations. So that's why they always want to decrease this particular capital number. So that kind of thing happened. The second thing was rating of the external agencies. That was a major issue where financial crisis happened and all models were built based on some assumptions from some experts which do not hold. The third thing, the third point where the problem did happen, people gradually started to understand that beyond the credit market and operational, which looks very straightforward risk, because very business, this actually deals with, reacts to day-to-day businesses. But apart from that, there are also other kinds of risks to involve, because during the financial crisis, the liquid, as you can see that the houses, you will hear this sentence like the houses went into a negative equity. A lot of subprime mortgage loans are given, then the houses go into negative equity. So what happened that external agencies rated high to wrong houses to get the loans to make more profits, and those portfolios got transferred hand to hand in multiple channels. And when the housing bubble burst, then basically everyone was trying to sell their houses, but as they can say that there is no one to buy, so that's a liquidity issue. So from there, actually, Basel 3 started. Basel 3 is, it does not only matter what capital, how much capital that you are putting as a reserve, it is also about how, what is the quality of the capital requirement. So now you can see that I wrote that CET capital requirement raised to 4.5% of RWA from 2%. So that is an increase. But what is even CET1? And you will also, since as you can see that this is CET1, there must be something named CET2. Otherwise, it don't make much sense. The difference between CET1 and CET2 is one can be, I mean, one you cannot use even after the transactional operations, another you can use. So, I mean, the total percentage of the capital ratio was same, but it is like enhancement of the capital quality. That based on that, you should that was also given a focus on. The second thing is 3% leverage ratio to be maintained to prevent excessive borrowing. That means the leverage ratio is defined as the ratio of the total loans that you currently, I mean the capital you currently have and the total loans divided by the total loans. So basically that amount also needs to be needed to be controlled. And the another thing is there are also two terms, that liquidity coverage ratio and NSFR ratio. So basically these ideas are that whatever assets I do have as a financial institution owner, our assets should be, I mean, any financial institution needs to have some amount of liquid assets which can be liquidated within 30 days under a stress period, and also a stable funding net service coverage ratio regarding this. So 1 year stable funding also required to required for, I mean, these are another aspects which came as a part of the Basel 3. So it is not about keeping some regulatory capital aside. It is also about to maintain the some kind of ratio to prevent excessive borrowing, make sure our assets have adequate amount of liquidity, also stable funding is available. So that is a better, healthier structure. So our discussion will majorly hover around this Basel 2 and Basel 3, because Basel 4, there is only one change which is very critical for IRB. Except that, I think there is not much change. So in Basel 4, what happened that there are certain corporate sovereign banks based on which actually actually the AIRB models cannot be applied. I will come more on this in the later slides, that what does this actually mean. All what you can see that there is a regulatory prescribed, and also FRTB came because earlier the lending book and the trading book has has some kind of boundary, but that boundary is a very fuzzy boundary. But gradually, what is happening at the moment, at present, is the more strict boundary between lending book and trading book, and also a cap which has been introduced for any kind of modeling that can be done. So if I build a 72.5% cap introduced for AIRB model for RWA, that means whatever the regulator suggests, let's say the regulator suggests $1,000 million needs to be reserved from one for one portfolio. Then this particular rule means that whatever I want to do, I can do. I can build a model very big, very small, fantastic. But what I cannot do, that report some kind of regulatory capital, which is $725 million, which is less than 72.5% what the regulators prescribe. So that is the rule. Why this came, I'll come later. Any questions in this slide? Okay. Let me. Okay. Very good. So let me move to the next section.
Yeah, hello.
Yeah, hi, yeah, yeah,
Yeah,
please.
this one. Can you repeat that 72% cap for ARB for a RWA in Basel IV?
Okay, let me explain the concept in detail. So the concept is there are two different kind of approaches for the model development, as I will explain more later. The basic funda is regulators prescribe already some kind of parametric values which you can use and calculate the regulatory capital, or you can build your own model. Now, from a bank's perspective, bank always wants to reduce the regulatory capital because they want to do business. So earlier what happened, that let's say the regulators prescribe, I mean, according to regulators methodology, $1,000 million needs to be kept as regulatory capital. Earlier, what used to happen, that people used to tweak the models. There are ways of tweaking the models to bring down the regulatory capital. Let's say regulatory capital is brought down to $500, which is 50% of the regulator prescribed capital. So before Basel IV, you can do that and you can actually pass the model, use your model. But post Basel IV, you cannot anymore use that. There is a there is a cap. So that means whatever modeling you do, you can you need to minimum reserve. You have to minimum keep 72.5% of the regulatory capital of a reserve from any modeling techniques. You can do whatever modeling you can, but the output you need to come up with must be at least 72.5% of the regulatory prescribed bound. Understood?
Yeah, yeah, yeah.
Okay. Now, key components of IRB credit risk modeling. So, as I already started talking about regulatory capital. So, what is the regulatory capital? I mean, the expression looks huge, but it is, it is pretty intuitive. Okay. But anyway, so PD, as you know, that for IRB modeling, PD definition is a little bit different. It is still likelihood borrower defaults, but IRB modeling is usually done on 1 year forward-looking window. So it is regarding that in the next 1 years, what is the likelihood of any particular loan getting defaulted. That particular thing is defined as PD. So it is a number. Uh, so it is a number. Now for between 0 and 1. Now for LGD, percentage of exposure which is lost or which cannot be recovered if the borrower defaults. The same formula also holds that LGD equals to 1 minus recovery rate. It is outstanding exposure at the time of default. Now there is one more term, that M. M is effective maturity of any loan slash exposure. So this particular thing, this particular thing comes because, as you can see, we can always calculate the loan per exposure. Okay, this amount, I have this amount of EMI per month. let's say I get defaulted after 38 months. So I am doing a heavy, nasty calculation. After that, I get some result. So it is pretty lengthy. And since IRB is a short-term looking metric, IRB methodology is a short-term looking metric, so it is not very effective. So for that, some kind of maturity adjustment has been done to every loan. I mean, it is per regulatory guideline, it is always between 1 to 5 years. So this particular aim should always take value between 1 to 5 years. Now that is completely regulators. But if I talk about any particular, so if I try to check any particular window that what should be my effective maturity at the moment, basically the regulator is interested to see the effective maturity. I mean, the maturity between 1 to 5 years, that how much amount of how much loss that they can get. So effective maturity has a formula, that is that the formula is not written here. So let me tell you. So this is the ratio of two things. Below below we always put the all sum of all cash flows. So what is a cash flow? Cash flow is whenever you are paying some kind of EMI, or you are, I mean, for this you are you are paying some EMI for if it is about, I mean, now let's move out of a credit risk for once, because cash flow is a very generalized concept. If I'm talking about a bond, it is about we need to pay the premium. And any bond kind, also there are some specific bonds which can give you timely yield before maturity. So all of these transactions which happen in money, these are all cash flows. So the definition is, this is a ratio of two quantities. In below, sum of all cash flows, and in top, it is product of cash flow and the time. So basically, in first month you pay some value, in second month you pay that value, in third month you pay that value. So in that way, it will happen. So that amount times 1 plus amount times 2 plus amount times 3 divided by sum of the amount times. Now, if the unit is monthly, as you can see, the difference between these two terms is only on the index of the month it has. Now, if we try to calculate the ratio, because EMI usually does not get changed. So from an EMI perspective, or any kind of loan which is a fixed premium perspective, which is the simplest form of loan, if you try to average out all of that, that is basically, I mean, 1 month, it is starting from t equals to 0 month and it ends at 60 month, right? In 5 years. Now, if we try to average out all of that, if you try to calculate the ratio for the simplest form of loan, what would you come up with? 0 to 60, that would be 30. And if this is a yearly transformation, so you need to divide it by 12. So it would be 2.5. 2.5. So in for any simplest form of loan, M should be something around 2.5. Now all of these terms are defined. So this is the formula. This is the formula. Now, as you can see, this particular formula, after dot, whatever is written, 1 plus m minus 2.5, this is the scaling factor. Before that, now first focus on the main formula first. So as you can see, this is the LGD, this is the LGD part, and something within bracket, there is a huge amount of things which is in the PD part. So what is so how this is coming? So basically, any kind of asset has two kinds of risks. One is systematic risk, other is idiosyncratic risk. And also, every asset, I mean, in the real world, nothing is independent with anything. So all the assets are also have their intrinsic correlation between them. That correlation is R. Okay. And if you try to calculate, if you consider the errors to be a Gaussian distribution, the normal distribution, and if you try to derive the probability of default, you will get this particular expression. One is the idiosyncratic component, the second the the first term is the idiosyncratic component. Sorry, the first term is the systemic component, and the second term is the idiosyncratic component, and normal of that. So in the systemic component, as you can see, there is the G of PD. So normal inverse of PD, which can be derived from the derivation. And in the idiosyncratic part, you can see a huge number has been put. So basically, idiosyncratic risk is idiosyncratic. That usually doesn't happen very often. That risk is random. So this particular thing is something which is out of your syllabus, out of the book. So how conservative you have to be. So basically, the Basel calculation is usually very conservative. Very conservative. I I could have put that particular curve here where there are three kinds of loss. One is ECL, then is Basel, and then is tail. Uh, so basically, we are talking about the second kind of loss. So basically, that's why this is more of an extreme loss. So for idiosyncratic risk, we are extremely conservative. That's why this 0.999 number is put. This basically signifies that this particular capital, I mean, out of 99 100 events, 99.9% events are better than this. So it is an extremely conservative scenario based on which we are trying to calculate this particular loss. So this particular thing minus my current PD, whatever it is. So basically, there is some systematic default which can happen in under any scenario. So basically, beyond that, what is my additional capital buffer that we should put as a capital? So this basically calculates that, and after that, there is an uh, adjustment factor which needs to be kept, because as you can see in this formula, there is no EAD. There is no EAD given, so you can consider it uh, as some adjustment factors to scale it up. Yeah. Any questions?
About it's hot, we are sweaty. So that sweat is collecting in your clothes, your underwear. Please buy
Yeah.
one for every day, or if you have one for every day.
I
We
guess
have at least
Isaac,
two.
can you mute yourself?
Then
So that it's always clean.
Yes.
Doctor,
Sorry. Yeah, thanks. Yeah, so Dipanshu, I have a quick question. So
Yeah,
so you
sure.
mentioned, so this formula, is it given by the regulator itself?
Um, this formula, the adjustment factor is given by the regulators, but this particular formula actually comes from a derivation. I think if you consider that the errors, I mean, any asset value follows I mean, asset value errors follow the normal distribution, then what is the probability of default? If we consider the Gaussian distribution, this particular formula gradually comes. There is a
Okay,
derivation.
okay. And is it something that is utilized like industry-wide for IRB calculation?
Uh, yes, very much.
Okay, okay. And for you mentioned about like we don't have EAD, but for PD and LGD, is it like through the normal, let's say PD through this logistic regression, and is it the same approach that we follow?
For PD, yes, we follow the logistic. Yes, usually we follow I mean, the follow logistic regression. I mean, in every PD model comes from some kind of logistic or any kind of classification, the
Mhm.
method, but the detail is about tweaking due to certain reason, because calibration is a huge costly thing to deal with that amount of data. So there are certain measures which are taken to make the model more stable. Some kind of decision trees are designed so that the model doesn't need to be recalibrated years after years. So some kind of tweak is there, which will
Okay,
come in the exact modeling approaches.
perfect.
Yeah.
Thank you.
Okay.
Actually, I have one question, Devanshu.
Yeah, yeah, sure.
So this formula, what we are seeing here, LGD and some PT, so is it to calculate risk weight?
Uh, this is to This is to calculate the exact capital with respect to one portfolio. Let's say I have one particular portfolio which I have 100 loans. So with respect to one single loan, I can apply this formula. So this is an additive measure.
The exposure value is not here, but whatever the value will come as
Yeah,
A, you will apply to the exposure.
yeah.
Okay.
Also, so you mentioned that let's say we have 100 loans. So let's say 10 of those loans defaulted. So like for the LGD, do we just take like the average of those 10 loans, or like how do we model that? Like how do we
Uh,
model the PD? Like PD would be okay, one, but then what about LGD?
Uh, Understood. So if a model, I mean, if a particular loan is already defaulted, I mean that this is a future-looking approach, right? So if a loan is already defaulted, so I think that particular loan doesn't have a future, so that is already off the book. However, we can utilize that particular data. That data is valuable, that particular loan defaulted. So this is a forecast measure. So let's say we usually calculate the 1 year PD from here. So PD comes out as a number between 0 and 1, right? Because if any particular loan gets defaulted, I believe that would not be added in the future looking calculation anyway. However, I got your question. So if it looks like, let's say, in my forecast window, one particular loan gets defaulted, let's say after 6 months. 6 months, then what is my remedy? Is your question around that?
Yes, yes. Sorry, yeah, it's around
Yeah.
that.
Okay. So actually the measure is taken as a 1 year format. However, so it is quite unlikely to get the PD value exactly 1. However, if we actually do get for some loans the value 1, then basically that particular loan, I think the whole what I would say, the whole amount of capital that particular loan holds. Whatever the whatever the balance loan amount, that whole amount goes under LGT at that point of time. After 6 months, it is not possible because it is not a time sensitive modeling, because in the IRB approach itself, we try to compute the 1 year TTC PD. Yeah, I'm not trying to come up to PIT to TTC at this beginning, but yeah,
Right.
that
Okay, okay,
yes,
okay. Thank you. Thanks, Devanshu.
yeah. So, so as you, so now I was talking about regulator prescription 10 minutes ago. So basically, there are two ways of doing it, doing this kind of modeling. Number one is foundation IRB, number two is advanced IRB. That was written as AIRB and FIRB. So for foundation IRB, banks only take care for their build their own PD model, and they take the LGD and EAD from the regulator prescription. For advanced IRB, bank estimates all possible inputs. So that is the main difference. Okay. Any more questions before we move ahead? Okay. Now, okay. Now, IRB approach, as you can see, that as I was already telling, that there are two kinds of approaches. One is which bank decide, one is which regulators decide. For US, it is Fed. For Switzerland, it's FINMA. For England, it's ECB, etc. So ECB, BOE. Yeah. Sorry. For England, it is BOE. For EU, it's ECB. Okay. So basically, standardized approach. So for standardized approach, the risk weights are fixed based on the kind of loan it is. Is it a commercial loan? Um, is it a retail loan? Is it a sovereign loan? So based on that, there are particular fixed risk weights around EAD, LGD, and in cases also PD as well. I mean, PD cannot be given as a loan, but if you try to average out from without doing any modeling, if you just average out the portfolio for quite some time and do any kind of vintage or role analysis around it. I think my previous speaker already mentioned it, how these are done. So for after doing some kind of trend analysis, if you just put those values and then try to look at the equation again. So if my PD values are given, the only thing which remains is R, and but R is already prescribed by regulators. So if you can put PD and LGD, then you can actually calculate this. So for these kind of things, they actually do not model anything. So this is simple and transparent, but I mean that is very suitable for low risk exposures, um, for who doesn't have a lot of amount of capital to manage loans to manage. I think that can be done. It has some downside too as well, because when you are relying on, I mean, you are not modeling anything, and just you are putting a formula to calculate such an important number. So you are basically relying on all the rating agencies what. So you do not have anything to justify yourself. And also since like you, I mean, like other people, you are using the same formula, what will be happening? You are kind of, it is kind of averaging out all possible kind of exposures. So when you try to average out, what would happen? The big spikes would flatten out. So basically, this particular approach is very less risk sensitive, but it can be done for lower exposure things. For higher exposure things, what they do? So banks estimate PD, LGD, EAD, and effective maturity from the data they have, and then they apply the formula. Risk sensitivity is obviously risk sensitive. Since we are building a model, it is quite complex and it is suitable for large banks. But what is the downside? The downside is definitely this particular methodology, since this is very complex, this should also be costly. Also there is one another issue. Let's say there are two competitors as banks. They are, I mean, they both want to bring down their capital numbers. So basically, they are trying the models. Now the point is to get a lesser number than its competitor. What they would try to do, they would try to come up with a completely different model, which would make the methodologies for a single asset. I mean, there is a single asset. There are two banks with completely two different methodologies. I mean, they are now as you can see that credit risk is PG times LGD times EAD. So how much different can it be? The difference is not there. The difference is how do you define the default? The difference is what kinds of assumptions you are making. The difference is how are you making the provisions. The difference is in that how the data, let's say macroeconomic data has few gaps. So how are you filling those gaps? Those also have different approaches. I mean, everything, every particular thing which comes as a component of modeling, directly or indirectly, can have an impact on it. So basically, that is also called the risk of tweaking the model assumptions, data, or methodology to report lower RWA. Because the regulators give banks flexibility to build the model on their own. So these kind of things would happen. So there are some classic examples of tweaking the model methodology. One is if a account is faulty suddenly, I mean, suddenly gets defaulted, do not have much history, those kind of the data points gets removed in name of EDA, exploratory data analysis. The second example is if we do see some abrupt seasonal movement, the movement which is idiosyncratic, we remove that particular time period while building a model. Now, the third thing is not taking not taking the bad years and building the model only on the good years, or building the model on so huge data, the ratio of data sets. Let's say I am taking the lesser amount of data points from the bad years and higher number of data points from good years from my sampling technique. So these are very classic examples of um, tweaking the models to get a lower RWA, and although it looks like that linear regression, logistic regression would give me a very good output whatever I do on the model. Unfortunately, that is not the case. It is not any magic boon. It only gives you the results according to the data you feed it into. So basically, if you feed bad data, it would give bad model. So if you give the data, if you feed it with data with very lesser amount of default rate, it has a chance to also represent lesser amount of default rate, which which is a limitation of this kind of modeling, which we would talk about at the end. Any questions?
So I have a quick question. So you mentioned about the internal rating-based approach, right? You mentioned about the maturity M. So my question is, I mean, I understand that the floor is kept to 1 and the cap is kept to 5, right? 1 to 5 is what the range is, I believe. But let's say if you have a 30-year, let's say, mortgage portfolio where most of your loans are like 30 years. So like what happens in that case is, do we take the maturity as like 5, or like how does that 30-year portfolios of bank translates into, 1 to 5.
Um, So they effectively use the same formula, and also also if after applying the same formula, what I mentioned, they get a number greater than 5, it obviously gets truncated back to 5. If it turns out to be less than 1, obviously it gets flowed at 1.
Okay, okay, thank you.
Yeah. Any other questions?
Yeah, I have one question. So,
Sure.
can you tell us what are the typical variables that are used in the PD model? Do you use
Uh,
MEVs or behavioral or demographic or a combination of these? And any,
Great. With that, let's start the next slide. Okay. So I'll just explain in this slide only. Okay. So now, uh, data preparation. So to build a model, the most important thing is data. You can be very good mathematician, you can be a very good statistician, but if your data is garbage, you will get a garbage model. That's the fact. Now, the point is that unfortunately, for building a credit risk model, all of the data sets cannot be found from one particular sources. So there are four kinds of data sets that one needs to start fetching data from, merge it to get the finally constructed raw data set. So the first thing is loan level data. So what does loan level data represent? Uh, for simplicity, you can think it of as very basic home loan. So for basic home loan, what are the basic variables that you think that we should come into? So the specific area from where you are, the agent via which you are applying for a loan, the channels, the policies against which you are putting the loan, against, what are you putting as a mortgage? What is its value? So that is called mortgage-backed property value because I'm talking about a home loan, MBS. So after that, the next thing is your income, your characteristics. What is your debt to income ratio? What is your uh, what is your loan to current loan to property value ratio? So these are some basic things that you definitely have. Now, what is your current loan to value ratio? What is your combined loan to value ratio? Because it might happen you have five different other loans as well. So basically these kind of data sets are getting accumulated at the under loan level data. So now for default data set. So per default data set per month, what is the history? So what is the history? So for the IRB definition of default is taken as 90 days past delinquency. So what happens? So basically, if you miss a payment for 30 days, you get flagged once. That is 30 DPD. Now, let's say you pay your due back in the next month and become non-delinquent, then your status is named as dirty current. If you have been never been delinquent in your entire loan history for this current loan, so then for this particular current loan, you would be mentioned as clean current. And then, so clean current, dirty current, 30 DPD, 60 DPD, days past delinquency, and then you get defaulted because in IRB, generally 90 DPD is default. For CCL kind of framework, 120 DPD is considered as default. But yeah, based on the business, banks, or products, it can change, but you get the concept. So also there are some voluntarily disclosure, there can be some bankruptcy. So based on this, so all of these data sets are are reported as a monthly level basis. So from this particular monthly level basis, we need to actually design the data in our way to calculate the default flag. Okay. Now regarding this loan level data, there is another thing. So what might happen that one loan, I mean, since the number of loans are too many and the number percentage of ones, that means percentage of defaults is very low. There are certain techniques to actually convert the modeling approach to something more fruitful. For example, there is a methodology. I would not mention it here, but you can definitely explore for your own interest. For low default portfolio, there is a very fantastic methodology named Pluto Tasche method. But I won't cover through that, and I won't cover through that today. But I would cover through which is more feasible and more practical. So basically, what would happen? There is a concept called loan tranching. So what happens if very lesser amount of loans are there? So basically, instead of building the models on loans, um, actually sometimes modeler decide the models to be built on tranche. So what is a tranche? The tranche is actually uh, let's say there are 1,000 loans under one portfolio. So what can happen that bank A can sell the uh, entire loan portfolio by tranching. By, by tranching, they can make it as a securitized credit product and sell it to bank B. And then instead of bank A, bank B will start chasing you because that is not A's responsibility anymore. So basically and if we build the model on a tranche level, then what would happen? The tranche default rate would be something like it will be values like which is very close to zero, let's say 0.013, 0.022, numbers like that, but it won't be exactly zero or one. I mean, exactly zero and one has another problems of modeling. So in, if they are very if, I mean if they are very imbalanced class, They represent very imbalanced class. So instead of that, what they do, they actually come up with some small the near zero numbers. I mean, there can be a tranche which can have 3 to 4% default, but yeah. So using that numbers, we do have a particular data, and then what do we do? So usually when my data set is in between, when my target variable is only 0 or 1, we apply logistic regression. Or what we can apply, if my data set in between, anywhere in between 0 and 1, then what can we do? We can actually map this data set back to the real number by doing the logic transformation. So they actually apply the logic transformation based on those small numbers, and then they run a typical regression, which is much more which is much more intuitive. And also, instead of giving only values around 0 and 1, the major advantage is it, since they are, I mean, since I'm using it in the form of linear regression, so it actually helps the loans to order some kind of riskiness category, which is fancier terms, or which in financial terms is known as risk differentiation. So that also becomes easier under this kind of model. Okay. So using these two data, I mean, only these two data sets are responsible for these kind of things. For two other points are macroeconomic data. Definitely macroeconomic data needs to be considered. So what kind of macroeconomic data is considered? Generally unemployment rate, definitely, for any kind of loan. Maybe GDP, for housing kind of thing, maybe HPI. So, based on the products, macroeconomic data also gets to a place. Exact transformation, people need to do some kind of transformation check to make sure the best transformation variables gets used in the model. So what might happen is, instead of GDP dot growth might be the best possible variable for modeling. And fourth is external data. So why do we need external data? We need external data. Let's say I am getting loans from different agencies. So in that case, I mean, it's good to have some external external ratings on these particular this kind of agencies. For that we use the data. For that we use external data. The second thing is, when my number of defaults are very low, I can use some external data which has a comparatively higher default probability, and we can mix those data sets. Obviously there are different rules around it, so that the data doesn't get any bias. But yeah, we primarily use external data for these two reasons. And often what might happen that uh, some kind of loan level data is not available, or some agency has very low representation, then we can collect some external data around it to give it a representation. So basically, these are my data sets. Now we can apply EDA, calculate, I mean, EDA means data analysis, cleaning, standardize the variables. From there, we can calculate the financial ratios like debt to income, these kind of ratios. We also can derive default definitions. Okay, sorry, actually, I actually didn't see. Yeah, okay. External data is data shared by credit bureau. Yes. Yeah, I actually didn't check the chat. So yeah, credit bureau
Also,
is always at external data. Yeah. Yeah,
Devanshu,
sure.
one quick question. So you mentioned about the macroeconomic data, right? I believe like the PD model that we built is through the cycle PD model for
Yeah.
Basel, right? For IRB. So my understanding is in PD, like we do not consider the macroeconomic variable because
Mm,
when we take into when we take into consideration the macroeconomic variable, then our model becomes like it gets
Point in
exposed to the
time.
it becomes more point in time, and also it becomes more exposed to the fluctuation that happens with the macroeconomic data.
Uh, yes, I mean you are both right and wrong. Yeah. So basically, yes, that is correct. If we apply the macroeconomic data, then my model would be then my model would be sensitive to the time period and the economic cycle. On the other hand, when we need to calculate the TTC-PD, let's say we are not getting a good model. So in that case, what we often do, we actually build a PIT model first and build a PIT model first using the whole macroeconomic data and such. Now, after getting all PIT data, what we do, we have the equation at the moment. So we actually change the PIT macroeconomic data points to a TTC macroeconomic data point. By how? By just simply averaging out. So we actually change that particular column, change that particular column, again recalculate those PDs. So that's how we calculate actually PIT PD to TTC PD.
Okay, so basically averaging out the effect of macroeconomic variables, right?
Yes, yes. And
Okay, okay.
remapping this in the model, yeah, there are two ways. We can also average out the PD as well, but I think that is not a very good approach, at least because what might happen that, I mean, PD would be equal in 3 or 4 quarters. That might not be very justifiable. So for that, we only average out the macroeconomic and
Also,
then remap the model. Yeah, sure.
yeah, also one question on data splitting, because since we need to train any logistic regression model or classification-based models, so I've seen like some modelers using like two splits, like train and test, and some modelers doing three splits, which is train data set, then we have test data set, and then we have validation data set. So, like, have you come across anything like that in your experience?
Yes, yes, definitely.
And like, when do
So,
we? Mhm.
yeah, yeah, please finish.
So like when do we use like either approach? Like when do we just use train test versus when do we use train validation and test? Because when I was building models, I remember doing train test, and a lot of my credit risk modelers, they used to do train test, but some of them also used to do train validation and then test. So how do you justify which one to opt for?
Okay, okay, I think there is, I mean, if we have ample amount of data set, there is only one correct way. So the point is the credit risk principle is my history. The first assumption for which IRB modeling has is the relationships between the variables will continue to repeat according to the economic cycle, and at least one financial cycle data needs to be considered for modeling. So if that is the case, now the trend test split, what does the trend test split ensures? The trends does ensure. It ensures that that there is no there is no firstly there is no sampling bias, and also it ensures that between the same period kind of data, if we randomly do something and try to train the model on one part for similar time period data, which is unseen for the model, for that particular kind of data the model is working fine. But if we even go back to the assumption, again go back to the assumption that the historical pattern will continue to repeat. So if you look at that assumption and then try to look at the testing procedure, can you see something missing? The missing part is that the continuation of the same pattern, it is not tested. So that's why out of time is an absolute must if given we have ample amount of data set. So basically your model, let's say you have a data frame window from 2008 to 2024. Let's consider a realistic case. Then in that case, let's say 2008 to 2021, a realistic approach could be we built the model on 2008 to 2021, split this particular data set in 80, 20, 70, 30, whatever you like, train and test, build the model on train, train it on test, and out of time both. If both are working fine, then if both have good model performance, then your model is working fine.
Okay, thanks, Devanshu.
Yeah. Okay.
Angshu, one more question regarding the TTC and the PIT. So can we simply use the IFRS 9 PD model and then take a long-term average? Would that give the parcel PD?
Effectively, it can. IFRS 9 PD, IFRS 9 PD, that means you are meaning the stage one, right? Stage one PD you mentioned.
Yes, correct. Yeah. As in
Yeah,
just
stage
the
one.
point in time PD, which we get from the IFRS 9 model, because we are using similar variables in the PD equation and then simply taking a long-term average.
The
I can
mean,
answer that. I can
yeah,
answer that. Like,
yeah,
so
sure.
Kritika, what happens is like generally all the IFRS 9 came recently, right? So all the banks
Mhm.
initially like Basel, like everyone had like Basel models, okay, which was like through the cycle, right? So, but then when this IFRS 9 regulatory framework came in, it wanted it to be more forward looking, right? So that's why the concept of point in time came in. So most of the places, most of the financial institution they have these, Basel models in place. Now, what at least the trend that I see is they are converting the Basel through like this TTC PD to point in time PD. So your question is just the reverse, like how to convert PIT to TTC. But what I'm trying to say is it's the TTC PD already exists in most of the places. Even if you want to do PIT to TTC, you have to remove the macroeconomic variable effect. Second thing you have to do is you need to average out the default. So let's say you distinguish the borrowers into five different categories, right? A, B, C, D, E. So you need to basically average out the defaults, sorry, average out the PD, and then basically scale the PDs. So that's what happens. But generally, what I've seen is like most of the banks they already have like TTC PDs or let's say Basel PD models already in place.
Yeah.
Okay.
Yeah, I think Mehul is right, and also I just wanted to add one or two things. So basically, IFRS 9 provisioning, I mean loss provisioning concept is quite new, and also it can be considered as a one in all kind of situation because the first stage actually resembles IRB, and the second stage majorly resembles the CECL methodology. And the third one is basically the accounting and the discounting book. So, yeah. So basically, that's why it looks so similar. However, from a practical point of view, as long as if the default definition, I mean, the default definition would be different for both regulations, except that I believe everything should be on track. I do not see any huge concern on that.
Okay, thank you.
Okay. And then after that, the next step is we need to perform the data sanity checks, which is very, very important whenever we are assembling any kind of data. And data sanity doesn't mean only manual errors. It also means whether the imputations that you have applied, whether those are making sense or not. Whatever data you collected from any sources, whether those are making senses or not. And then the next step would be the obvious one, developing the model. Now the next slide is regarding the segmentation of assets. Now, if we apply apply the IRB approach, so according to the regulators, what is the basic classification of different kind of uh, different I would say different kind of assets. So basically, which we can model, and what are the regulatory prescribed methods and typical practices around the industry, that what kind of thing is applied where. So the left hand side has residential mortgage, revolving credit exposure, and other small exposures which contributes to retail. For these, except PD, LGD and EAD aren't usually modeled, and for AIRB and FIRB, so Foundation IRB and Advanced IRB, under those falls large financial exposure, corporate exposure, institution exposure, high net worth loan. So under these, those are wholesale kind of wholesale sites. For those, actually defined modeling techniques are usually developed on. and and for more specific, I mean that for exact formulas, there are exact Basel guidelines with exact formulas, so there isn't a much concern. I mean, there is no huge scope of modeling if we do have everything decided by the regulators. Now there are different model methodologies. I think vintage analysis, roll rate analysis, transition matrices, those things are already mentioned by my previous speaker. So those are definitely very good techniques uh, to build the PD model, to build the PD models. And for LGD, some survival analysis has been considered, and some and some empirical analysis has been mentioned in the previous session. So basically, I think those methods can also be applicable here. So for avoiding the repetition, I did not mention that. So today I will discuss about one more methodology, which is very effective for some of you who are already aware of the scorecard modeling. It can resemble some kind of scorecard modeling, but this is a very traditional and clever way to bypass all the huge data issues. And this is this is used in a lot of industries as well. So basically, from the input data, you come up with a process data. Now, for left hand side, there is a PD model. So what do happen? What I mentioned earlier, that whenever we are tranching the load, so basically the point in time cumulative default, we can calculate the point in time cumulative default rate with respect to time. So every data set, if we consider the quarterly rate for every loan, so basically for let's say a loan has been on live for 15 years. So with respect to that particular, I mean, let's say a tranche is live for 15 years. So for that particular tranche, there are 60 data points while we are considering the PIT cumulative default rate kind of thing. So basically, we are calculating the cumulative default rate for every tranche, and we are building the datasets around it. Now, after building the dataset, we are applying the linear regression model at the tranche level, or we are applying the logistic regression model at the loan level. So after getting the whole output, we do have the point in time default probability. If we consider the model on the loan level, after getting the probability, after getting the modeled ones and zeros, from there we can calculate the point in time cumulative default rate, because we can. So basically, at the end of the day, we would be coming up with the cumulative default rate at a tranche level. We can tranche after the model or before the model. That's your decision, but anyway, we can tranche it. So once we have the point in time cumulative default rate, then we also have the logistic or linear regression equation with us. Now, in that linear or logistic regression equation, if we transform all the point in time macroeconomic variables to through the cycle macroeconomic variables by just doing an average, and re-estimate the PIT CDR according to that, So basically, that would convert it into a through the cycle PD, right? And at a tranche level, we will get a 1 year through the cycle PD, and after getting all the data points, after we would just take an average to calculate the 1 year TTC PD. Now for every tranche, we do have one data point of through the cycle PD. So after that, what we do, we do perform a decision tree. We do build a decision tree for and come up with very specific segments. So the decision tree, on what variables will the decision tree be built on? It will be built on the same variables on which the regression has been built on. So there would be one, two variables which would be prevalent for decision boundaries. And what do we do for future loans? We just use those boundaries to automatically assign this particular TTC-PD for the capital calculation. So that's how we can actually bypass the whole modeling thing every time a new loan comes into a tranche. Any questions?
Sorry, could you please explain the last line? We will bypass the NMO loan committee.
Sure. So did you get up to TTC-PD conversion?
I'm not, actually, I'm not very close to this modeling work, but
Okay,
theoretically, I understand that we calculate the point in time LGD based upon historical data and then
yes.
look after the collateralization and default or economical angle and add additional MOC, something
Okay,
like that. Yeah.
okay. So what I mentioned that what we are doing, we do have point in time cumulative default rate for every tranche. Now, what we would be doing for those, at a loan level, we would be, the at a loan level, GDP or HPI does not actually matter because that is an index. So that there is already a constant value. So at a tranche level, if we instead of taking the instead of taking the PIT value of the macroeconomic variables, if we calculate the through the cycle value of macroeconomic variables, how can we do that? Just average those four out. So we would be replacing the PIT value of GDP by TTC value of GDP, and we would re-estimate the cumulative default rate using the exact same equation, but the data one particular variable or two particular variables which are macroeconomic variables, those values would be changed. So that would give me possibly a different number. So that different number would be my TTC-PD for that particular tranche. Now let's say there are 200 tranches. So against the 200 tranches, I would be after TTC-PD conversion, I would be with 200 TTC-PDs. Now, what do I do? So basically, running this model is pretty expensive. And as you can see, this is a very key concept of not loan provisioning, but taking a capital calculation. Anytime a loan comes, we need to assign some capital according to it. So every time we cannot realistically run the model. So what do? We actually build a segmentation based on the PD values coming from the tranche. We build some decision tree around it, and every decision tree has some boundary variables. So it would look like if spread at origination is greater than 3 years, then assign the PD to 0.02, something like that. So in this way, the decision tree outputs do come, right? In different buckets. So we use those exact same buckets to estimate any future loans. Now, when do we recalibrate the model? That has some signs. I would mention it in the monitoring, within the monitoring section. So, yeah. Any other questions before we move to the LGD part?
So this bucketing of tranches will be done based upon the industry of the borrower, or is it totally different?
Can you repeat that question?
So the like we have PD models for different industry-wise borrowers. So, or
Yeah.
like repack counterparties will have different PD scorecard model, or the large corps or banks will have different, right? Or is it rating this?
No, scorecard. No. Scorecard has a very different concept, and so just keep it. I mean, the model, all of them can be logistic regression, but keep it aside. The scorecard has a very different goal. Okay, it is like a 1-0 decision thing, but but here for every data point we need to assign some positive number to it, positive or zero to it. So yeah, the goal is something different, but yeah, I'm not really sure what your exact question
Yeah,
is,
your voice
Mehul.
is really weak. Yeah, even I'm not able to hear properly. Like, can you come closer to the mic and say like what are you asking?
So like when you mention about bucketing, uh, how you do it? Is it based upon industry-wise or
And we use
Base.
decision tree. Decision tree is a very well-known technique.
okay?
So are you referring to the segmentation or like
Yeah, he mentioned about assigning this microeconomic factor by averaging out to the tranches and then bucketing them into uh, that how you bucket.
so yeah, so basically, okay, so I guess from his experience, he mentioned about dysentery, but from my experience, what I've seen is it's like some people what they do is they just use like let's say one parameter, let's say FICO score, right? They bucket the customers based on FICO score, let's say 300 to 400, 350 to 450, 450 to 550, so on, right? They'll make like
Mm-hmm.
5 to 8 buckets, and then basically let's say we have thousand customers in each bucket, right? So for those 1,000 customers, whatever PD we have thousand, so we'll have 1,000 PDs, right? For each bucket we'll have 1,000 PDs, so we just average out those 1,000 PDs to arrive at bucket level PD.
Okay, yeah, got it.
Is that right?
Yes.
Yeah, is
Yeah. So I think, Mehul, so after bucketing here also we do the bucket level PD as well, because as you can see, let's say in one bucket 40 tranches do fall. So how do I assign? I would obviously make the average, but based on the decision boundaries which you mentioned, I think that is more of a scorecard approach where you mentioned that the equal weight kind of specification. And also there is one more thing in scorecard, that particular term is named as odds to double, right?
right.
So based on that, we actually solve those equations to get the minimum and maximum boundaries. I mean, I cannot remember more specifics, but yeah, there was some equation solving around it to get the starting point and the ending point, and then we divide it into equal intervals. Not
Right,
equal intervals, equal population intervals. Yes.
right.
Yeah. So now
So that
moving,
process, can we call it binning?
uh, for
So
scorecard, it is binning, but here it is okay. Decision tree is a okay. Let me explain decision tree. No worries. So decision tree is a technique which actually, let's say you have a data set where you have a target variable here, just like here, and based on that you have to derive a decision tree. So how decision tree works? Decision tree works in this way that you have 5 variables, so decision tree will always split it into segments, not necessarily equal, so that the observed category in the first class and the observed category in the second class would have maximum Gini score among it. So maximum difference, it will always make sure it would split in such a way so that the difference between two branches would be maximum. Okay. And after
Also,
that, yeah, yeah,
Also,
sure.
to his question on the binning, so we have different types of binning, right? I mean, but binning is actually done before you train the model. So like let's say we have something called coarse binning or equal width binning, right? So basically, you do it before you train the model, but the segmentation thing, you do after the model is trained and after the PDs are calculated.
Yeah, yeah, that too
Okay,
as
okay,
well.
thanks.
And to answer Yogesh has mentioned something I think which is very
Okay.
worth mentioning, that Yogesh mentioned that we are creating different segment based upon weight of evidence of variables, and I think that's very much that makes sense as well, because weight of evidence is also for every variable. The weight of evidence acts like the key differentiation factor for positive for between ones and zeros. So if one particular variable has this kind of differentiating power, so that can be definitely used, because at the end of the day in decision tree I am also I mean decision tree is a machine learning algorithm, but I mean a very primary level of machine learning algorithm. But yeah, it works also similar kind of things too. The the whole clusters always get split in such a way so that the difference between the observed variables is always maximized, and then it would be further differentiated. Okay. Now moving to LGD section. So for LGD section from the dataset, we similarly can calculate PIT loss severity as well. Now the problem is for LGD, the numbers are always between 0 to 1. So as you know that the problem of the linear regression, so it can go beyond 0 and 1. But for LGD usually cannot go, I mean theoretically it can go beyond 0 1 interval in some cases, but from a practical modeling perspective it should not go towards 0 and 1. So there is an advanced level of logistic models which is known as fractional logit model. I think we are already very late, so I won't go very detail around I mean fractional logit model. But to be precise, every model, everything that we build, for example, linear regression has an objective function. Um, what is that? L2 norm of y minus x beta. So basically, since linear regression is an objective function, so logistic regression has an objective function that as well. So what is it? So basically, it is like pi, yeah, x to the power pi 1 minus x to the power 1 minus pi, something like that, and p can take value only 1 and 0. So what does fractional logit do? Fractional logit actually makes it the likelihood function makes it separated. Okay, separated, and then turns out to be an optimization problem which actually gets solved by the computer. Okay, that particular expression doesn't, I mean just like logistic regression, that particular likelihood function doesn't have a closed form solution. So but let's forget about that. I think what matters is from this particular point. Now what we do, we actually, just like the way we calculate the TTC-PD, here we calculate the downturn LGD. Why? Because loss given default gets optimized during the worst quarters only. So how do we calculate downturn LGD? For that, we actually look at the whole distribution of the macroeconomic variables. Now we either put 75th in the percentile from the extreme side or 90th percentile from the extreme side. We take those kind of values, one extreme value, and we replace those extreme value of that macroeconomic variable in the equation back again, and then calculate the downturn LGD. And from that, using that downturn LGD, we again put it under the decision tree to perform the LGD segmentation. Any questions? Okay. Acha, okay, I can see one question. Oh, okay. No worries. Let's move to the next section then. Now,
Sorry, so
yeah,
if
yeah,
time
sure, sure.
permits.
Sure, sure.
So, like you mentioned, if there are the cases where we observe significant losses in the data, you allocate that, or you consider those cases into the original data set and then recalculate.
Mm, what I mentioned that we often see the LGD breaching beyond 0-1 interval. Did you want to point on that only?
Yeah,
Or
I thought downward, this economic downward impact is kind of.
oh, okay, okay. No, no, no. I mean, let's say there is one data from 2002 to 2025, let's say. So obviously we know for macroeconomic variables where the downward would come. In 2008 to 2011, we'll see the macroeconomic trend downward, right? So basically, basically this is regarding the downturn LGD. Yes, we do put it back to calculate the LGD, but it is something, I mean, why would I again put the entire LGD to the entire data? Because it is something happened to the history. We are just reusing that history to get a conservative estimate of LGDs, nothing else. Right?
Okay.
Because if you see from the formula, unlike PD, LGD gets calculated straight away. There is no idiosyncratic risk component for LGD unlike PD. If you remember the formula, one factor hesitant formula.
Yeah, there are no macroeconomic factors. Here I understood there will be macroeconomic downward impact, additional add-on to the point-in-time LGD and other things. So if we are calculating the forward-looking model for LGD, so sometimes, like in the practical database, we observe there the economic downward, this additional add-on got increased significantly for particular portfolio or particular industry, say. It might be coming from some input data or some macroeconomic changes.
So, Sumit, on your question, basically, when you talk about forward-looking, that is what is IFRS 9 framework, right? Like we model a different macro. So, like I'll put it in simple words. The Basel framework, generally, I've seen it is called TTC through the cycle PD, and generally we do not take into consideration the macroeconomic variables. Even if we take macroeconomic, we'll just average it out so that the macroeconomic variable does not have any effect on the PDs. Okay. But what you are asking is forward-looking PDs, right? Those is IFRS 9 framework in which
Sorry, my
we
question was from LGD perspective. The right side, he mentioned convert PIT loss severity to down LGD.
Understood. I think I understand. I
okay.
got an idea of what you asked, right? Yeah, I didn't get it. Okay. So the point is, what you are, I mean, the way you are thinking is uh is a little bit inappropriate from the IRB perspective. The way you are thinking that, okay, let me think it like IFRS 9 or CECL, where for the entire lifetime of the loan, that is the CECL regulation. So lifetime of the loan, I need some kind of provisioning. So for that, actually, I need something very dynamic PD, dynamic LGD, dynamic macroeconomic variables. But my IRB methodology is destined to give me one number which would give me enough capital for 1 year. So in between this 1 year, so that is why the goal and the fundamentals of this modeling is we do not consider macroeconomic variables as a moving variable. We always consider macroeconomic variable as a static variable. Now, if my macroeconomic variable gets as a static variable, then to be conservative, I need to consider all possible worst scenario cases to ensure that I have reserved enough capital or reserve to mitigate if any bad scenario comes. Whatever I am doing under PD component or taking as a downturn LGD is related to that only.
Okay, got it. I think that's why we don't see more frequent changes to these MOCs or downturn add-ons or other add-ons hardly once in a year. Uh, might be regulatory
Uh,
asking the changes.
I mean, once in a year for an IRB modeling, the model change is an overkill. Might be once in 3 years, 5 years, might be the good way.
Mm-hmm. Thank you.
Okay, okay. So pre-implementation model testing. So I have built a model, but how do I ensure that my model is good? So before putting it into the implementation, that means I do not have any real life forward-looking data to test it against. So what can I do? So I do perform diagnostic testing in estimation methods to ensure all models are suitable for usage. That means whatever logistic regression, linear regression that I am applying, all the matrices around it, like for linear regression, for linear regression, the mean square error, RMSE, etc. And for logistic regression, AUC. After that, positive. For these kind of models, I think positive, false positive rates, and and I believe decile score, whatever gain, lift, whatever you can actually calculate for this particular kind of under diagnostic testing. For backtesting, in sample, out of sample data separately. Also, I forgot to mention it also needs to be tested out of time too. Yeah, I missed it here. So basically, because I have split my data in three different parts. Number three is sensitivity analysis on each categorical and numerical risk parameter. So how do we perform this sensitivity analysis? So for numeric analysis, it is easy. For categorical analysis, basically we actually perform how do we perform the sensitivity analysis on the categorical thing? So basically, there are some categorical variables which might have two or three different kind of categories. So what we do, we actually transform all of, let's say, one particular column has only three entries, x1, x2, and x3. So we make all of them x1, then all of them x2, and then all of them x3 to ensure which is more sensitive and prone to the particular risk. So this kind of sensitivity analysis needs to be done. Uh, for categorical variables, it doesn't hold huge value in most of the cases. In some of the cases, they can. When, for example, let's say something is coming from an agency, whether an agency has some inherent risk associated with it. So if we put each agency name there, then you will be able to see if whether any particular agency is very unsafe or not. In that case, categorical sensitivity comes into play. And number four, which is the main thing from a business perspective. So there is a regulatory capital. So if you apply the formula, do not build any model, you will need to keep X amount of reserve. After doing the modeling, you found that you would get Y amount of reserve, right? You need to keep. So if Y is greater than X, then your model will never go live. Okay. Now, if Y is marginally less than X, then basically the calculation will happen from the business perspective. Y plus the cost of putting that particular model, maintaining it into the production, uh, and serving I mean, giving the access to the clients using it. If the whole cost is less than X, then only your model goes live. Otherwise, it will not go live. And the delta is the actual regulatory amount of capital that you are saving and giving back to the financial institution for business. So if you are a modeler, uh, if you are not a junior modeler, if you are a very senior modeler, I mean, if you work in a modeling team, then this is one of the KPI of your AMD. Okay. Any questions? Now, let's say the model is fine, the model gets implemented. Now, how do we monitor the model? So, whatever was there in the previous slide that already gets monitored any which way. Now, for the post implementation, what is new once the real data comes in? So, basically, we already come up with the PD and LGD buckets, and whenever any new loan do come in, we actually put our assessment based on these buckets only. We do not run the model again, right? So we need to make sure that the live loans which are current, which has not been closed yet, so those particular loans needs to be checked from quarter to quarter basis, and we need to calculate their PSI or CSI at a very frequent basis and make sure that those stays within bounds. I do not know the exact bounds for your case. Yeah, I mean that varies. It is for our case, if it is over 0.2, then that's a flag. Uh, yeah, yeah, okay, 0.25, it's fine. For our case, 0.1 is less than 0.1 green, 0.1 to 0.2 amber, and over that is red. Now the point is, the next thing is we often need to compare the data relevancy by comparing the live portfolio. So we need to compare the current live portfolio by distribution of key variables in the data. How do we identify the key variables? The variables which are used in the regressions of the models, those are important. Which are used for making the buckets, those are even super important, which is a subset of that, but those are super important. So we actually need to look at the distribution from time to time between the live portfolio and the portfolio on which the model was built. Now, there are different ways to check the distribution. I mean, difference in the distribution. Kolmogorov-Smirnov is one of the best ways to check the distribution difference. Now, if PD or LGD is underestimated in the is now PD, yeah, or LGD is underestimated in consecutive quarters in recent times. If there is an underestimation, then that's a backtesting issue, and maybe you are I mean your model is open to some allowance of credit provisioning or some loss. So if one of these cases do happen, I think third one is the most severe. In that case, we should definitely have a look at the model, followed by 2, followed by 1. So if either of these tests uh, the model needs to be recalibrated with latest data. The best way to check, I mean, before recalibrating with the latest data, the last thing that we can do some test, which is again from scorecard analysis. So what we do, often we include the defaults in the portfolio as a to consider the reject inference and check if the model coefficients to change or not in scorecard. We can use the same concept here, and we can actually run the model first to check if the if the if the I mean if the signs are changing or not, if the coefficient is changing too much or not. Okay. Any questions? All right. So I think this is the penultimate slide. So yeah, the key challenges, number one is definitely low number of defaults, hence getting good data which has some amount of default so that the model does not underestimate ones and overestimate zeros, because this is a portfolio that we are talking about that has, let's say, 1.5% ones and raise zeros. So if we predict everything as zero, then also my model would be I mean that my model has a very high accuracy score, but that might not paint the true picture, right? So that's why data checking the data quality availability is a very big challenge. Mixing internal and external data times without any time series bias. Risk estimates, which Mehul mentioned sometime before, risk estimates often get sensitive to economic cycle. That is a reality. Even after doing all of these risk estimates, whenever we are going through a good cycle, suddenly PD becomes lower. When we are supposed to go through a bad cycle according to economic cycle, suddenly risk estimates go higher. PD goes higher. I mean, if PD goes higher, then we are well and good. But when PD gets lower, that is actually a concern, projected PD, because that is the time when the underestimation and actual credit loss provisioning do happen. When my uh, economy suggests that we are going through a good time, but the business environment might show us a different picture. Those are the areas when actually these kind of models do not perform very well, and also huge costs associated with recalibration of the model. And there is a fifth one, which I didn't write it here, but what might happen in this kind of data set, there might be some presence of actual some time series trend. There might be some presence of actual time series trend. In that case, we cannot perform any kind of trend analysis or component analysis. So this is a huge drawback, because in this kind of models we often put randomly 1 lakh term here and there, but that is not an econometric modeling. Econometric modeling is something very, I mean, everything is a regression, but it is fundamentally something very different. Now, the future trends, I think these are more, I would say, more emerging trends. That number one is for PD estimation, rather than using this huge amount of work based on complicated models, build some complicated models which does not work from time to time. So machine learning methods are gradually tried out on PD estimation. XGBoost is very popular specifically. Climate risk integration would be done gradually on these kind of models. When I mean climate risk, again speaking, since macroeconomic variable doesn't have an impact, so it doesn't have a clear impact, but there would be some scenarios under which the model cannot work. So we need to identify those kind of situations in advance. And for LGD modeling, just like I think someone suggested in the session itself, so LGD scenario based LGD modeling is just like, I mean, there has been some suggestions to build some scenario based LGD modeling for this, just like other time sensitive scenarios like IRB CCL. Any closing remarks or any questions? I believe my presentation ends here. So
Yeah,
thank
this
you
was
for
great
hearing me.
session. Yeah, this was great session, Devanshu. Thank you for, walking us through your expertise in credit risk, and yeah, I really loved the presentation.
Okay, thank you very much. So I'd be sharing it soon. If not today, definitely tomorrow. So yeah, thank you. Thank you for tolerating me for almost 2 hours. It was great, great presenting to you guys too.